Hey everyone, welcome back to Corporate Decoder. Today we're diving into Royalty Management Holding Corporation's annual report. Get ready, because this one's a bit like finding a diamond in a coal mine, and I mean that literally, given what this company does. It's a wild ride through royalties, debts, and some interesting accounting moves. We'll focus on what actually matters so you can understand what's going on. First off, this is a Form 10-K AS-E, which means it's an amended annual report. They had to refile to include their compensation clawback policy, effective December 1, 2023, a detail they initially missed. It's basically a rule that lets the company take back executive bonuses if something goes wrong. That's a good signal. Companies are being responsible. So what is Royalty Management Holding Corporation anyway? They started as a blank check company, meaning they were set up to merge with or acquire another business. In late 2023, they merged with Royalty Company, trying to build value by acquiring and developing high-value assets, especially in struggling communities. Let's talk about real estate for a second. They lease office space and land from affiliated companies, including one in Kentucky for just $250 a month, and another in Indiana historically for just over $2,000 but adjusted to $1,000 a month plus common charges. Also, they lease land in Kentucky for $2,000 a month and land in Indiana with a minimum of $2,000 a month, or 20% of gross revenues. It makes you wonder if they got a good deal. Now onto the good stuff, financials. First, the boring legal formality stuff. The aggregate market value of the company's outstanding stock held by non-affiliates is about 14.9 million shares of common stock outstanding as of mid-April of 2025. Let's focus on the stock numbers. At its high point, the stock was valued at $22.97, but it dropped to $1.50 to a low of 0.70 cents, which is super volatile and not a good sign for investors, to a low of $0.70, which is super volatile and not a good sign for investors. Okay, here's where things get more interesting. The company can issue a bunch of preferred stock, and during the last quarter of 2024, they issued 225,000 stock warrants as compensation to the board of directors for 2024 and 2025. Keep an eye on related party transactions, as they often raise eyebrows. They can also buy back their own shares, and as of the end of 2024, they repurchased over 31,000 shares at an average price of about $0.92 per share. Their revenue for 2024 was about $807,000, which is an increase from about $488,000 the previous year. The total operating expenses also increased. They held total assets of $15 million on both years. Total liabilities decreased, and they had retained earnings of $1.2 million. A critical accounting policy for this company relates to warrants. They are classified as liabilities and remeasured to fair value each reporting period. This can create volatility in the business due to the change in fair value recognized in the statement of operations. Okay, here's what the actual numbers look like. Let's quickly look at the financials. The environmental services revenue is $686,000, an increase from the previous year. The fee income, however, decreased, and rental income had a small increase. Overall, their total revenue increased substantially year over year. On the expenses side, general and administrative expenses increased, as did professional fees. Total other income increased by a lot, but their net loss is still over $100,000, which is not great. Assets are roughly the same year over year, but total liabilities decreased because they converted debt to preferred stock. The loss per share isn't too bad, just a cent per share at the end of 2024. It is CM3 Advisory that is doing their accounting. That means there was a change from the previous year. Let's jump into where the cash is coming from. They had a net loss of negative $114,000, negative $1.1 million, yet the cash provided by operations is a positive $646,000 last year. They spent negative $18,000 last year. They spent negative $18,000 last year, decreasing cash from the year before. The cash adjustment is mostly from non-cash transactions that don't affect the cash position itself. FT are a few of the cash adjustments, as $50K, $75K last year from amortization expense, SECU 116Ms from the issuance of preferred shares for service, foreign negative item, which is mostly a paper transaction. Non-cash transaction, the adjustment to public warrants. A difference between both years comes from paying less related party debt and the issuance of preferred stock shares in 2024. Looking into the equity portion, we see the details on the shares. There are 5,000 shares of preferred stock authorized at a very low value per share, plus another 5,000 with a value of 1.000. In addition, there are common shares authorized of $100 million shares. The company has a number of accounting changes to consider, including their credit losses, estimates, and revenue recognition. Digging into their investments, we see they hold shares of FUB Mineral LLC and Ferox Holdings Limited. Those are valued at $612,000 and $9.6 million respectively. So they have a few convertible notes receivable with Heartwater Inc. worth $750,000, Ferox Holdings Limited, and Advanced Magnetic Lab Inc. Their intangible assets are largely made up of mining permits, LLCs, and companies. The total value was nearly $2 million. Also, as a note, they have restricted cash with the Kentucky State Treasurer due to some mining permits. Okay, their main costs are comprised of leases to various facilities. Their amortizing leased assets total $33,000 a year for right of use. Warrant liabilities are another large item. Their public liabilities are worth $98,000. The notes payable to related parties are $0 in 2024. They were $1.68 million last year. This may be because the debt was converted to equity. This company comes with a lot of risks, mostly due to related party transactions, potential dilution of shares, and overall the nature of their small organization size. This also means that control of the company is in the hands of initial stockholders who will most likely approve any deal on their own. Looking at these results more broadly, Royalty Management Holding Corporation is attempting to turn around struggling assets, but potential investors should definitely approach with caution due to high risks, volatility, and potential conflicts of interest. I'll think back and comment.